Stop buying gold right now, because it won't just lose value, it will expose one of the biggest misunderstandings in modern investing. Gold has surged to record highs, filled every headline, and triggered a fresh wave of hype about resets, collapses, and safe havens. But the truth behind this move is far more structured and far more revealing. After more than a decade studying futures markets, commercial hedging, seasonality, and the psychology behind safe assets, one thing has become obvious. Gold is not the protection people think it is. It's not a prophecy. It's not a warning sign. And it's definitely not the escape hedge the headlines make it out to be. Gold is a positioning market, and the people who move it aren't the ones shouting about it online. In today's video, I'm going to show you why gold's recent retreat isn't random, what the past century of data actually says about these cycles, and how commercial traders, the smartest money in the room, positioned for this pullback long before the public even saw it forming. And most importantly, if gold isn't a safe haven everyone believes it is, then what are professionals actually seeing in markets right now? That's where the real opportunity begins. Once you understand the rhythm behind the move. What is really happening in gold? Gold's recent breakout looked like a major event. New highs, dramatic headlines, and what felt like a tidal wave of content predicting collapses, resets, and revaluations. But if you've lived through more than one gold cycle, you already know this isn't new. Every gold rally creates the same emotional arc. Fear rises, excitement follows, and panic hides inside the analysis. But the public only sees the price. They never see the architecture underneath. Every major gold move begins long before the crowd notices it, and it always follows the same three-stage pattern. Commercial traders accumulate quietly into weakness. Retail traders panic and sell the lows. And once the rally gets underway, funds chase the trend late and amplify it. Then, as the move matures, retailers finally jump in, just as commercials begin distributing into strength. This isn't a coincidence. It's a repeating phenomenon that has held true for decades. When you line up gold against real yields, positioning data, and sentiment trends, the pattern becomes undeniable. Gold rallies when real yields weaken. Gold tops when commercials start hedging. And the moment emotions overtake structure, the cycle starts to unwind. Gold does not move on prophecy. It moves on positioning. People say real education is expensive. But in trading, it's actually the wrong education or no education that ultimately becomes the most expensive mistake you can make. But one of our goals at Online Trading Campus has always been to make professional trading education more accessible without lowering the standard or compromising on what truly matters. To support more beginners, more developing traders, and more people who want to learn this the right way. You can now join the Blueprint program. When you use the direct checkout link below, you get immediate lifetime access to the entire Blueprint, which includes a private welcome call, access to the Blueprint course video program suitable from beginner to advanced traders, access to live trading sessions multiple times daily, access to all our proprietary indicators, an invitation to an instant funded campus fund account of up to $360,000, and a welcome into the community of 4,000 plus like-minded traders. I hope to welcome you into our community soon. Understanding the players behind the market. To understand why gold behaves the way it does, you first need to understand who's actually in the market. Commercials are the largest and most informed participants. They hedge real businesses. They accumulate into weakness. They distribute into strength. And when their positioning reaches an extreme, they're almost never wrong. Funds and large speculators chase trends. They enter moves halfway through, and they often exit them halfway through. They amplify the cycle, but they don't define it. Retail traders are the emotional engine. They react to headlines. They follow narratives, and at extremes, they consistently end up on the wrong side of the trade. Most investors never see any of this. They see a chart, react to a headline, and unintentionally repeat the same behavior the data has shown for 30 years. But once you understand these three groups, and once you read the COT report, the gold market stops looking like chaos and starts looking like choreography. Why gold rallied and why it stalled. If you look at gold's positioning before the rally began, the setup was textbook. Commercials were reducing shorts and quietly accumulating. Retail traders were aggressively bearish. Funds were neutral. That's the foundation of every major gold rally. But then the pivot happened. As gold pushed into new highs, commercials quietly shifted. They began reducing long exposure, increasing hedges, and preparing for weakness. Meanwhile, retailers moved by headlines and narrative piled in at the top. And because funds use momentum signals, they added even more fuel to the move, expanding a rally that had already lost structural support. But here's the part no one is talking about. The COT report, the only data set that shows what commercials were doing, was delayed because of the US government shutdown, which means the public was flying blind, trading narratives, chasing emotion, completely unaware that the smartest money in the market had already moved into defensive posture. This wasn't a collapse, it was the natural unwinding of a move that commercials had already disengaged from. A pullback wasn't surprising, it was inevitable. The timing behind the move, seasonality. Now let's talk about timing. Seasonality is one of the most misunderstood concepts in markets. Most people look at calendar-based seasonality, the average January charts, the average April patterns. But true seasonality, built from actual trading day data, tells a completely different story. Gold historically strengthens into Q1 and historically stalls afterwards. This year followed that script exactly. The rally aligned perfectly with seasonal strength. The stall aligned perfectly with seasonal exhaustion. Seasonality isn't a prediction tool. It doesn't tell you where price will go. But when seasonality aligns with commercial positioning and valuation extremes, it becomes one of the most reliable timing windows we have. And if you want to understand how true seasonality actually works and want to see how seasonality pairs with supply and demand on a gold chart in a practical application walkthrough, I've already made a separate video on it. I'll leave this gem link below. In this gold cycle, all three signals align. Valuation. When emotion outruns logic, there's another piece of this story. Valuation. At its peak, gold was trading far above fair value, or 20% above the upper valuation bands that historically attract commercial hedging. And no market, not even gold, can sustain emotional pricing forever. If gold were truly an inflation hedge, the metal should have exploded higher during the massive inflation surge in 2021 and 2022. It didn't, because gold doesn't follow CPI. It follows commercial behavior. And commercial behavior was signaling caution long before the public noticed it. How professionals interpret gold. Professional traders don't treat gold as a hedge or prophecy. They treat it as a real-time data set, a mirror that reflects trust flow inside the financial system. Professionals don't ask, where is gold going? They ask, who is positioned behind this move? And they look at commercial accumulation or distribution, retail extremes at tops and bottoms, seasonality timing windows, valuation disconnects, real yield movements, and institutional supply and demand zones. Retail traders buy gold because it feels safe. Professional traders read gold because it reveals behavior. And that difference in perspective is everything. A practical look at gold, what positioning really shows. Now let's bring this all together with a real example. Because when you apply commercial behavior, retail extremes, and seasonality to gold's actual chart, the pattern becomes unmistakable. If you look back at the last two major gold bottoms, both moments were defined by the same setups. Retail traders were heavily bearish at multi-year extremes, convinced the metal was finished. Commercials, on the other hand, were doing the exact opposite. They were quietly accumulating, covering shorts and positioning for strength. And what happened next? Gold didn't just stabilize, it exploded higher. Not because the news changed, not because inflation changed, but because positioning changed. Retailers capitulated, commercials stepped in, and once funds joined late, the move accelerated. Now, compare it to the recent high. Retail traders weren't bearish, they were euphoric. Commercials weren't accumulating, they were hedging. True seasonality wasn't strengthening, it was rolling over. The exact inverse pattern of every major bottom. This is why the recent pullback shouldn't feel surprising. It should feel familiar. Because once you understand how commercials behave, you stop asking where gold is going and you start asking who is positioned behind the move. And in today's cycle, the people who matter, the commercials, were already preparing for weakness long before the headlines appeared. Why could gold still decline further? Because the positioning that matters most, commercial positioning, turned bearish ahead of the pullback. And because the public still doesn't have the updated COT report. The COT blackout means retailers are buying the story without the data. Commercials hedged aggressively at the highs. Seasonality has rolled over. Valuation remains stretched. Real yields are stabilizing. Funds are unwinding. This isn't a collapse. This is the cycle doing what it always does. Retail buys the hype. Commercials fade the hype. And price follows commercials. The signal is not emotional, it is structural. The real reset, trust rotation. The term reset gets used a lot, but it rarely reflects how markets actually function. Markets don't reset in a single moment, they rotate. Trust flows from metals to yields, from yields to equities, from equities to technology. And today, more and more of that trust is migrating into artificial intelligence. When trust leaves gold, it doesn't vanish, it moves. And right now, positioning data, ETF flows, and yield behavior all point in the same direction. Institutional trust is rotation into innovation, especially AI. Gold is not the beginning of the next major repricing event. It's the end of the previous one. The next major rotation is already underway. Gold isn't collapsing because something broke. It's repricing because the smartest players in the market position for weakness, while the public position for excitement. This cycle is not new. It's the rhythm of the gold market, commercial accumulation, retail emotion, seasonal timing, valuation extremes, and trust migration. And once you understand this structure, the headlines lose their power. Emotion loses its influence, and gold becomes what it truly is. A mirror reflecting the flow of positioning beneath the surface. But here's the most important part. Trust never disappears. It rotates. When it leaves metals, it moves somewhere else. When it leaves safety, it moves into growth. And right now, the same trust that's leaving gold is quietly flowing into one of the fastest expanding sectors on the planet, artificial intelligence. Commercial positioning, ETF flows, and yield behavior all point in the same direction. Institutional capital is migrating toward innovation, automation, productivity, and AI-driven growth. So in the next part of this series, we're going to follow that rotation. We'll break down why AI is absorbing trust at a pace we haven't seen since the early tech boom, how institutions are positioning for it, and what that means for the next major repricing event. Because the story doesn't end with gold losing momentum. It begins with where that momentum is going next.